Good day everyone, my name is Joby Ann M. Panutsol from BSB 2 Second Schedule. For today's video, we will gonna talk about the supply theory as well as the two categories of supply theory. So, let's start.
We will start by knowing what is supply. When economists refer to supply, they mean the relationship between a range of prices and the quantity supplied at those prices, a relationship that can be illustrated with a supply curve or a supply schedule. So there are two categories of supply theory. There are the firm supply and industry supply. We will discuss first the firm supply. Under the firm supply includes types of firms, supply functions, law of supply, and producer surplus. We will discuss first the types of firms. Firms can assume many different types based on their ownership structures. The first one is a sole proprietorship or sole trader is owned by one person who is liable for all costs and obligation and owns all assets. The second one is corporation. A corporation is the business's financials are separate from the owner's financials. Owners of a corporation are not liable for any costs, lawsuits, or other obligations of the business. A corporation may be owned by individuals or by a government. Partnership. A partnership is a business owned by two or more people. There is no limit to the number of partners that can have a stake in ownership. A partnership's owner each are liable for all business obligation and together they own everything that belongs to the business. The last one is financial cooperative. It is similar to a corporation in that its owner have limited liability with the difference that its investors have a say in the company's operation. Let's move on to the supply function. When the quantity supplied is expressed only as a function of the price of the product, other factors remaining constant, it is called a supply function. The following is a simple supply function. Quantity is equals to 400 plus 1.5 price. The positive sign indicates that the price and quantity supplied are positively related. When the price increases, the quantity supplied will also increase. In the above example, for every 1 peso increase in price, the quantity supplied will increase by 1.5 units. The information from the supply function can be plotted as a simple graph with quantity supplied on x-axis and price on y-axis. This is called a supply curve. Next is the law of supply. The law of supply is one of the most fundamental concepts in economics. It works with the law of demand to explain how market economies allocate resources and determine the prices of goods and services. The chart depicts the law of supply using a supply curve, which is upward sloping. A, B, and C are points on the supply curve. Each point on the curve reflects a direct correlation between quantity supplied and price. So at point A, the quantity supplied will be quantity 1 and the price will be the price 1 and so on. The supply curve is upward sloping because over time, suppliers can choose how much of their goods to produce and later bring to market. At any given point in time, however, the supply that sellers bring to market is fixed, and sellers simply face a decision to either sell or withhold their stock from a sale. Consumer demand set the price, and sellers can only charge what the market will bear. The last one is producer surplus. It is the difference between how much a person will be willing to accept for a given quantity of a good versus how much they can receive by selling the good at the market price. It is the total amount that a producer benefits from producing and selling a quantity of a good at the market price. So let's proceed to the industry supply. The group of firms producing homogeneous product is called industry. In fact, the concept of industry exists only under perfect competition. An industry is said to be in equilibrium when it has no tendency to increase or decrease its level of output. Under the industry, supply includes industry equilibrium in short run and long run, zero profit, rental rates, and price. Long run equilibrium of the industry. An industry will be in equilibrium in the long run if the following two conditions are satisfied beside the equality between the long run supply and the demanded for the industry product. First, all the firms in the industry should be in equilibrium. Second, there should be no incentive to entry into the industry by the new firms or compulsion for the existing firms to leave it. In other words, the number of firms should be in equilibrium. Next is zero profit. In economic computation theory, the zero profit is the condition that occurs when an industry or type of business has an extremely low cost of entry to or exit from the industry. Is zero profit a loss? Zero accounting profit, though, means that a company is running at a loss. This means that its expenses are higher than its revenue. The last one is rental rates. Rental rates are the periodic charges per unit for the use of property. The period may be a month, quarter, or year. The unit may be dwelling unit, square foot, or other unit of measurement. The price is the sum or amount of money or its equivalent for which anything is bought, sold, or offered for sale.